Folks, it is time to wake up to the yellow metal. Yes, the yellow metal just crossed 4,000. We now have people talking about 5,000, 10,000, and yes, even 20,000. We've got the legend Ray Dalio just this morning warning that this is the early 70s and you need to step up your allocation to gold. So we're going to talk about gold, but hopefully we're going to talk about a bigger story because it is more than just gold. This could be the melt up. The U.S. dollar is having its worst year since 1973. And folks, you better wake up because this is going to impact your bottom line. It is going to impact your net worth, and it can set you up or destroy you in the future. Let's get into it. Anna, gold just hit 4,000 for the first time this morning. What is going on? What is the story? And of course, where is it going?
It's amazing. I tell you what, I am thankful that I started buying gold and silver a few years ago because in large part, because you mentioned Ray Dalio. I started reading Ray Dalio and I knew who he was. I mean, he's big time in, the investing space, one of the largest hedge funds in the world, and really a smart guy. He has a lot of books on principles, and he wrote a book called Principles for a Changing World Order, followed by Principles of Big Debt Cycles. And he actually has another new one out. I haven't bought it yet, but it's on my list of things to do when I get through the ones I'm reading. And what he basically said was the kind of story that isn't getting enough attention is really where the United States is going in terms of our debt to GDP level. And what he did very briefly is he spent about 10 years with, I think, 100 data employees on a project to go back and look at every major economy and how they rose and fell. And the reason is because he said part of his investment thesis is, we can get what we know really right, but it's those things that we don't understand that really are kind of what we consider these black swan events that can cause, lots of disruption. And it's things like natural disasters and wars and internal conflict and external conflict. And one of the other things that brought a lot of countries down that were once at the top of the global picture is debt. And what he found is that when countries get to high debt to GDP levels, whatever that was that they traded in, it might have been silk, it might have been gold and silver, it might have been opium, all kinds of things in the global trade. But essentially, when they got too much debt, it led to the decline of those countries, and then another country, rising up and taking over as the next great superpower. And so what he talked about was the trajectory of the US debt. And that's really what it's all about, Michael, because essentially when countries get into too much debt, they only really historically have had three options that they've taken to get themselves out of it and to stay at the top. And it's one, you cut expenses, austerity. You drastically cut what you give to the people. Number two is you raise taxes significantly, sufficient enough that once you get your expenses down, you bring in enough tax revenue to essentially have a balanced budget. If they can't do that, Michael, it's usually because they have too much debt and they're paying interest on that debt. Does that sound familiar? Right? And so what happens is when they can't cut expenses and raise taxes enough, they allow something called monetary inflation. And what that means is they essentially print money in different ways. So what our US government does is we sell treasuries, we sell IOUs, basically to bring in money. We're the seller, we bring in money, we promise to pay a future interest rate. Well, when that debt to GDP gets so high that we can no longer bring in enough tax revenue to even pay the interest on that debt, the country's at risk of defaulting. And that essentially is kind of what's happening now. Our debt to GDP is so high that countries, which are the largest buyer of US treasuries, companies, insurance companies, investment firms, individuals who are buying treasuries start to say, you know what? I'm worried that the US might default. And if they continue to print dollars, meaning they're just creating money out of thin air, what it does is it devalues the value of the money that you currently have. It reduces your purchasing power because now your dollar is one of $2 million in circulation instead of one of $1 million in circulation. So your purchasing power goes down about 50% over time. So what happens is, as the government is being looked at and big money, the smart money, the bond money, and the other countries are saying, We think the US is going to have to print. That means we expect more monetary inflation, a devaluing of the dollar. Then they want to hold less treasuries. And so the US dollar as a world reserve currency starts to lose favor and value. And what's happening is central banks are by and large dumping US treasuries or the US dollar, and they're going back to purchasing large amounts of gold. And a lot of them are talking about going back to some new kind of system where currencies are pegged to gold again. They can't exactly go to a gold standard, but they want to hold gold. The other reason, Michael, is because when Russia went to war with Ukraine, and we basically confiscated and locked up their treasury assets, basically it was what's being called weaponization of the US dollar. So countries around the world that don't view us as their allies are saying, wait a second, if we do something wrong or we do something the US doesn't like, we're not going to be beholden to them. So there's been this shift for both of those reasons, to buy gold. So part of the really skyrocketing increase in gold, it's gone up way than the stock market has in terms of its annual percentage rise in the last 2 years, is because central banks have been buying so much, and that's driving up the price. But also those investors, funds and individuals like us are starting to say, you know what, we have the same worries about monetary inflation in the future. And if you're holding cash or cash equivalents in a money market account, US treasuries, whatever it is, when you see the writing on the wall that if we don't get our deficit under control, you understand that that's going to create inflation again, large, long-term inflation. That's going to devalue your dollar. And therefore, you want to hold something that has stable, hard assets that fight against inflation and that hold their value. Well, gold is the number one asset that has done that historically. And so I believe that we're kind of at this tipping point where people are starting to realize we need to hold gold as a hedge toward monetary inflation and the US debt continuing to rise, which it is on a trajectory to continue to rise. Although this administration is trying to flatten that curve and get the debt to GDP to flatten in the next 9 years and then start to go down, the next decade is a wild card. And whether we lose world reserve currency and tank as a country, which a lot of people think, smart people think is possible, despite us never wanting to believe that is, holding hard assets like gold, even silver, it's like the poor man's gold, and real estate is really how you hedge the future monetary regime of inflation. And that's why we've hit 4,000 today, no doubt in my mind. And here's the reality, Michael. If the debt continues to rise at the level that the CBO anticipates that it's going to rise, the estimates are, because gold does go up when countries' debt goes up, the estimates are gold will hit 10,000 by the late 2030s and 25,000 by 2052. That's something that C. Michael Howell, I believe it is, basically did a trajectory out to look at what does gold do when the debt goes up. And if we stay on the current path that it looks like our debt to GDP is heading, that is how high gold could get. So it'd be really smart for you to at least consider owning some gold, buying some gold. You have to understand it's volatile. It doesn't provide an income. It's money that it's basically your insurance policy against monetary inflation that you've got to buy and you've got to hold. And it can be bumpy. There can be times where it goes up. I think we're probably at kind of a cyclical peak. You've got trends, economic trends that are cyclical or short-term. Then you've got secular trends that are long-term. So we've got a cyclical trend right now of gold going up. But if we continue a long-term new regime of lots of global debt, then there will be a long-term secular increase in the value of that gold over time as well.
Yeah, I think you brought up everything that I was thinking about. I do think this is kind of the perfect storm for gold, silver, even Bitcoin you could throw in there. One, you're absolutely right. The confiscation of Russia's treasury bills, locking up, weaponizing the dollar was a red line that was crossed and is causing behavior to change, right? We are seeing countries increasingly, not only reduce allocations, but sometimes even go to zero of U.S. treasuries. And thus they have to put money elsewhere, and gold seems to be a big winner.
Right.
The other thing you're right about, we really should give Ray Dalio his props. He ran Bridgewater, one of the largest and most effective, so he knows what he's talking about, right? He's just not somebody, chasing clout. He's earned it. And the fact that he's referencing the early 70s should give everybody shivers. I mean, it should
Yeah.
make you pucker up and go, I got to take care of myself. If you don't know the 70s were not a great decade. The early 80s, back-to-back recessions. This is not fun. These were not the glory days of the U.S. economy, right? The 70s were rough.
Right.
And, we need to pay attention. And then lastly, when I step back from this, and yes, gold's getting the headlines as it should, crossing the 4,000, and there's calls at Goldman for 4,900 and now calls for 10 and 25,000. It's kind of like nothing stops this train.
Yeah.
But when I step back and go, okay, where, what do I want? And I think you're right. It's hard assets. And if you're just getting started, go get some silver coins or, gold coins and, tuck them away, because you're right. No income, but, it's a nice insurance policy. But at the end of the day, I just go back to what you and I do mainly, which is real estate. And it's like, if they are really going to get on this, monetize the debt over the next couple of decades, I want to own as much income producing real estate that cash flows day one with 30-year fixed rate debt. It's like,
absolutely,
they're just going to eat my debt away. I'm going to be paying this off with cheaper and cheaper and cheaper dollars. It's like free money, right? And at the end of the day, I think we're about the following statement has always been true, but I think it's going to be more important for the next decade. And that is, inflation is a feature, not a bug. Invest like it.
Yes, absolutely. And Michael, I think where people start to get things a little bit wrong when they talk about, oh, it's the cycle or whatever, we have been conditioned to invest based on business cycles, and real estate typically it actually leads business cycles. So real estate kind of goes first into an expansion, then you have a peak, then you have a decline, and then you ultimately hit the trough or the bottom of that cycle, which is called a recession, and it all starts over again. And real estate generally leads you in and then leads you out. And then behind that is manufacturing, leads you in and leads you out. So there's definitely cycles. And usually what happens, Michael, is that when you are you've finished your expansion, you're at the peak and you're starting to contract a little bit, the stock market actually is going up. And the stock market actually goes up on inflation till it's about 2 or 3% inflation. And that's why the Fed tries to keep inflation below 3. They like 2, but anywhere between 2 and 3, you're still kind of at a peak of stock market values generally. Then when inflation goes beyond 3%, that's when equities start to really fall. And what normally happens is when equities are high, like the S&P keeps hitting its all-time highs, gold is way down. And the reason is because the thought is, hey, if the economy's booming, I don't need this insurance against economic decline or high inflation. And so usually in a typical cycle, equities are up and gold goes way down. And then when the market starts to fall, then people sell out of equities and then they buy gold as kind of a hedge. And that's not what's happening. There's this disconnect. And again, it's because those are short-term cycles. We're now having to look at much longer-term secular cycles. And so where macroeconomics, the big picture that kind of leads years and years in advance, people don't pay a lot of attention to in good times. When things are shifting and you have potential real paradigm shifts in the monetary system and in the global debt and these debt and liquidity cycles, it's really important to pay attention to the long term. And so the other thing that's really important, you kind of alluded to in terms of owning real estate, if we're just looking at the short-term cycles, you might say, okay, real estate is in a slump, so we shouldn't buy it, or it's hard to produce income right now. That's true, right? It is very difficult right now, but in the short term, you have to start thinking long-term as an investor. And during an expansion, you can flip houses, you can flip apartment buildings, and people have done really well doing it. But in a decline, all of those things get harder. So you have to get better and you have to look for those needles in a haystack or the parts of the country that have great deals or fire sales and these motivated sellers. But you do need to scoop up assets in this next decline when rates do continue to fall, at least in the short-term rates. And there's some pressure in certain areas of the country where prices continue to fall. That's the time to pick something up, not with the short term, I'm going to flip it in a year because we're going to have a booming economy, but the long term, I'm going to buy it as cheap as I can, put on the longest debt I can at the lowest possible rates. And that's how you're going to have this asset that you hold very long term into the next 10 or 20 years that provides you what we love about real estate: some income, some appreciation, maybe slower appreciation, we'll see, but that preservation of capital, especially against inflation and the dollar. So I'm still very excited about real estate. It's very important to have some of it in your portfolio. If it cash flows, it's definitely better. You don't want alligators. But real estate and gold, I think, really are the asset of the future that's going to allow people to grow wealth, and not just grow it, but preserve it against inflation that is going to devalue the value of every dollar you have coming in over the long term coming forward.
Couldn't agree more. Anna, you're amazing. Thank you for being here each and every week. Where can people find you?
You can find me here. You can find me on social media at Anna Kelly REI Mom, and you can find me at Anna Kelly Investing for real estate and wealth coaching and advice.
Awesome. Thank you so much. Take care. Have a great week.
You too.